On June 18, 2020, the foundation of Europe's most celebrated financial technology empire cracked open in real time. Ernst & Young, the auditors who had rubber-stamped the books for a decade, abruptly refused to sign the annual report. $2 billion in cash, supposedly sitting in escrow accounts in the Philippines, simply did not exist. The loss wasn't just in the billions, it was the total erosion of trust in an entire regulatory apparatus. A DAX 30 titan, valued at $28 billion, was exposed as a hollow shell. This was the collapse of Wirecard. The architecture of this deception did not begin with a grand master plan, but with a structural glitch in global digital payments. In the early 2000s, processing credit cards for online pornography and unregulated gambling was highly lucrative but toxic for traditional banks. Wirecard stepped into this shadow banking void. Under the leadership of CEO Marcus Braun, the company positioned itself as the indispensable middleman, absorbing the compliance risk traditional institutions refused to touch. Braun draped this gritty reality in the sleek, impenetrable vocabulary of Silicon Valley disruption. As e-commerce exploded, Wirecard needed to show exponential growth to justify its soaring valuation. But scaling a payment processor globally requires banking licenses in every jurisdiction, a slow and agonizing process. Here lay the vulnerability in the system. Wirecard exploited a mechanism known as third-party acquiring. Instead of processing transactions themselves in regions like Asia and the Middle East, they outsourced the work to local partners. These partners supposedly handled the payments, took a cut, and passed the bulk of the revenue back to Wirecard. It was a brilliant black box. Because the third-party acquirers were located in opaque jurisdictions like Dubai, Singapore, and Manila, the actual flow of funds was practically invisible to German regulators. Braun and his chief operating officer, John Marsalek, weaponized this opacity. They booked massive, high-margin revenues from these offshore partners, inflating Wirecard's balance sheet to staggering proportions. The company wasn't just fabricating numbers, they were fabricating an entire parallel ecosystem of phantom clients and ghost transactions. By 2018, Wirecard had achieved the impossible, ejecting Commerzbank, a pillar of German finance, from the prestigious DAX index. Marcus Braun, in his trademark black turtlenecks, was hailed as a visionary. But the true predatory mechanics of the fraud were shielded by the very institutions meant to expose them. When short sellers and investigative journalists began flagging anomalies in the cash flow statements, the German financial regulator BaFin did not investigate Wirecard. Instead, they launched criminal probes into the short sellers, citing market manipulation. The regulatory state had become an unwitting bodyguard for a massive corporate fraud. The fatal flaw in any financial heist is the necessity of hard currency. You can fake revenue, but you cannot fake cash balances indefinitely. The systemic reveal came when the Financial Times, after years of relentless reporting, forced a spotlight on the mechanics of the escrow accounts. Wirecard claimed that the profits from their Asian third-party partners were being held in trust by independent banks. This was the linchpin of the deception. The cash wasn't remitted back to Germany. It was allegedly pooling in accounts overseen by obscure trustees. When a special audit by KPMG was finally forced upon the company, the auditors did something unprecedented. They demanded direct, unmediated proof from the banks in the Philippines that the $2 billion actually existed. The banks responded with a devastating truth. The documents provided by Wirecard were forged. The trustees were compromised. The third-party acquiring business, which accounted for all of Wirecard's reported operating profit, was a complete fabrication. The unwinding was violent and absolute. Within days of the auditor's refusal to sign the 2019 accounts, Marcus Braun was arrested, his shares worthless, his billionaire status vaporized. John Marsalek, the architect of the shadow operations, boarded a private jet to Belarus and vanished into the geopolitical ether, leaving behind a trail of intelligence connections and burned investors. Wirecard filed for insolvency, leaving a crater in the European financial markets. The autopsy of the company revealed a staggering failure of fiduciary duty across the board. Auditors had relied on screenshots and forged PDFs. Regulators had protected a national champion at the expense of market integrity. Board members had ignored glaring red flags in pursuit of stock options. This was not a failure of a single executive, but the systemic exploitation of a globalized financial network. The perpetrators identified the blind spots between national regulators, exploited the trust inherent in audited financial statements, and built a $28 billion empire on thin air. The cash was never there, the innovation was a lie, and the system that allowed it to happen is still vulnerable to the next architect of corporate illusion. 3,000 miles away from the European regulatory failures, a different kind of financial illusion was taking shape inside the fortress of Wall Street. The London branch of JP Morgan Chase operated as a citadel of modern finance, a high-security nerve center where billions of dollars flowed through fiber optic cables in fractions of a second. Inside the chief investment office, traders were insulated from the noise of the retail banking floors. Their mandate was simple but terrifyingly broad, tasked with managing the bank's excess deposits and hedging against global macroeconomic risks. The environment was a pressure cooker of quantitative genius and unchecked ambition. Screens flashed with the complex architecture of synthetic credit markets, a digital landscape where traders did not buy or sell actual corporate bonds, but rather derivatives that insured against corporate defaults. At the center of this web sat a trader who commanded such massive positions that the market felt every move he made. He was known to hedge funds and rival desks simply as the London Whale, a man whose trading book was so gargantuan it distorted the very waters he swam in. To understand the glitch in the JP Morgan system, you have to look at the original purpose of the Chief Investment Office. It was designed to act as a conservative shock absorber for the bank. If the broader economy faltered and corporate loans went sour, the derivatives held by the office would increase in value, offsetting the losses. It was a classic hedge, a financial insurance policy funded by the bank's massive pool of excess deposits. But the system had a fatal design flaw, as the line between hedging risk and taking proprietary, speculative bets was dangerously blurred. The executives overseeing the system relied on a mathematical model known as value at risk. This metric was supposed to calculate the maximum potential loss the trading desk could suffer on any given day. It was the ultimate dashboard warning light. However, as the London Whale's positions grew exponentially, the bank quietly altered the model. They replaced the existing formula with a new, untested algorithm that artificially halved the perceived risk. The warning light was simply disconnected, allowing the traders to accumulate massive, complex positions without triggering internal alarms. With the risk models effectively neutralized, the procedural mechanics of the trade became a daily exercise in doubling down. The desk began selling vast amounts of credit default swaps on a specific index of corporate debt. By selling this insurance, they collected immediate premium payments, generating the illusion of steady profits. But this strategy required the corporate debt market to remain perfectly stable. When the market began to turn, the desk found itself trapped. Because their positions were so massive, they could not unwind the trades without causing a market panic and taking catastrophic losses. Instead of admitting defeat, the traders manipulated the daily valuation procedures. They stopped marking their positions to the actual market prices, a fundamental violation of accounting rules. Instead, They recorded the trades at prices they hoped the market would eventually reach, effectively hiding hundreds of millions of dollars in daily losses. They built massive spreadsheets to track the divergence between reality and their fabricated books, creating a parallel financial universe inside one of the most heavily regulated banks on Earth. The daily reports sent to senior management in New York showed a stable portfolio, while the trading desk in London was secretly hemorrhaging cash. The collapse of this synthetic credit portfolio was swift and merciless. Hedge funds caught the scent of blood in the water, realizing that a single massive entity was trapped on the wrong side of the market. They aggressively bet against the London whale, forcing the prices further out of JP Morgan's favor. The synthetic derivatives, once hailed as a sophisticated hedge, became a financial weapon turned against the bank itself. The losses accelerated from millions to billions in a matter of weeks, shattering the illusion of impenetrable risk management. When the dust settled, the synthetic trading debacle cost JP Morgan Chase $6.2 billion. The aftermath exposed a shocking reality about modern banking supervision. The supposedly sophisticated risk committees had failed to understand the very instruments they were supposed to monitor. Regulators levied over $1 billion in fines, and congressional hearings laid bare a culture of arrogance and systemic negligence. The London whale was not just a rogue trader, but the inevitable product of a financial system that prioritized short-term paper profits over fundamental risk oversight. On June 18, 2020, the foundation of Europe's most celebrated financial technology empire cracked open. Auditors from EY refused to sign off on Wirecard's annual accounts. A gaping hole had just materialized in the balance sheet. 1.9 billion euros, supposedly sitting in escrow accounts in the Philippines, simply did not exist. The loss wasn't just in the billions, it was in the total erosion of trust, a catastrophic failure of the regulatory safeguards designed to keep public markets clean. Within days, a corporate titan valued at 24 billion euros would file for insolvency. Its CEO would be behind bars, and its chief operating officer would vanish into thin air. To understand how a fraud of this magnitude incubates in plain sight, you have to look at the architecture of modern digital payments and the men who recognized its blind spots. Marcus Braun, a former consultant with an affinity for absolute control, took the helm of Wirecard in 2002. The company's origins were rooted in processing payments for pornography and online gambling, industries traditional banks refused to touch. Braun saw the stigma not as a liability, but as a moat. He understood that high-risk, high-volume transaction processing required a labyrinth of global intermediaries. The glitch in the system that Wirecard exploited was a mechanism known as third-party acquiring. When Wirecard expanded into Asia and the Middle East, they claimed they lacked the regulatory licenses to process payments directly. To bypass this, they outsourced the work to local third-party partners. These partners would allegedly process the transactions, take a commission, and hold Wirecard's share of the revenue and trust accounts. It was a brilliant structural maneuver. It moved the core engine of Wirecard's profitability offshore into jurisdictions where European auditors had zero visibility. By 2018, Wirecard was untouchable. It ousted traditional banking giant Commerzbank from the DAX, Germany's prestigious blue-chip stock index. Braun cultivated the aura of a tech visionary, projecting an image of relentless, algorithmic growth. But behind the polished investor presentations, the psychological profile of Wirecard's leadership was defined by predatory paranoia. When short sellers and investigative journalists began pointing out glaring inconsistencies in the company's Asian operations, Wirecard didn't just deny the allegations. They weaponized the legal and regulatory system. They hired elite law firms to bury critics in litigation. They allegedly deployed private intelligence operatives to hack and stalk journalists. The deception was so fiercely guarded that the German financial regulator, BaFin, did the unthinkable. Instead of investigating Wirecard for accounting fraud, BaFin banned short selling of Wirecard stock and launched a criminal probe into the journalists exposing the fraud. The system designed to catch the criminals was actively running interference for them. The true mechanics of the deception lay hidden within those offshore escrow accounts. The narrative sold to institutional investors was that billions of euros in cash were sitting in 2 Philippine banks ready to be deployed for strategic acquisitions. But financial forensics eventually revealed the brazen simplicity of the con. The money was never generated. The third-party partners were shell companies operating out of residential addresses or shared office spaces in Manila and Dubai. The revenue was fabricated through a carousel of forged invoices and phantom transactions. To satisfy the auditors at EY for over a decade, Wirecard executives and their co-conspirators simply forged bank confirmations. They created a closed loop of fake digital money to cover up massive, bleeding operational losses at the company's core. They were running a global shadow bank where the primary currency was fabricated documents. The facade finally shattered on June 18, 2020. Auditors from EY delivered a fatal blow, refusing to sign off on Wirecard's annual accounts because 1.9 billion euros, a full quarter of the company's balance sheet, simply did not exist. To understand how a payment processor built an empire on phantom cash, you have to look at the glitch they exploited. Wirecard began in the late 90s, processing credit card transactions for high-risk online gambling and pornography. Under Markus Braun, an Austrian executive adopting the black turtlenecks of Silicon Valley royalty, they acquired a German banking license and rebranded as a digital payment pioneer. By 2018, Wirecard was untouchable, replacing Commerzbank on Germany's premier DAX 30 index. The engine of this deception was the third-party acquirer. In countries like the Philippines and Singapore, where Wirecard lacked licenses, they claimed external partners processed transactions and deposited massive profits into escrow accounts. It was a perfect black box. Wirecard booked hundreds of millions in revenue backed only by forged letters from shell companies. When short sellers pointed out that Asian subsidiaries generating half the global profits operated out of residential addresses, Wirecard weaponized the state. The German regulator BaFin took the company's side, filing criminal complaints against investigative journalists and banning short selling on Wirecard stock entirely. But phantom money cannot sustain a physical empire. A whistleblower leak forced the supervisory board to commission a special audit by KPMG. The resulting report was a masterclass in corporate devastation. KPMG could not verify the Asian profits. Investigators flew to Manila only to find forged signatures from Philippine banks that had never even heard of Wirecard. The cash flow was a ghost. Within days, a 30 billion euro market capitalization vaporized. Marcus Braun was arrested, stripped of his billionaire status, and hauled into custody, still claiming a shadow conspiracy. His chief operating officer, Jan Marsalek, the true architect of the Asian network, executed a flawless extraction. Funneling cash through crypto channels, Marsalek boarded a private jet near Vienna and disappeared into the geopolitical shadows, highly suspected to be operating under state protection in Russia. The illusion of absolute control is a dangerous narcotic, and nowhere was this more evident than inside the chief investment office of J.P. Morgan Chase. Designed as a conservative fortress to hedge the bank's massive structural risks, the division quietly mutated. The mandate shifted from protecting capital to aggressively multiplying it. At the center of this transformation was a London-based trader named Bruno Ixil. Ixil built a colossal synthetic credit portfolio using complex credit default swaps, specifically targeting a corporate debt index known as the CDXIG9. He was essentially selling insurance on corporate debt. As long as the market remained stable, J.P. Morgan collected massive premiums. The strategy earned Ixil immense internal praise and the autonomy to scale his bets, but it required an astronomical amount of underlying risk. His positions grew so massive that hedge funds dubbed him the London Whale. The glitch that allowed this to happen was the bank's internal risk metric, known as value at risk, or VAR. When Ixil's massive positions began triggering internal limits, the chief investment office didn't reduce the trades. Instead, they changed the mathematical model. They implemented a new VAR formula that instantly halved the calculated risk, a systemic manipulation that deliberately disconnected the alarm bells and blinded upper management in New York. Inside the London trading room, the psychological pressure cooked at a rolling boil. Traders were trapped in an echo chamber, watching the liquidity of their chosen derivatives dry up. They were too big to exit. Any attempt to sell would crash the market and instantly realize their monumental losses. Desperate, they resorted to mismarking the books, deliberately mispricing positions to hide the bleeding. But you cannot hide a trade of that magnitude in a zero-sum arena of apex predators. Competing hedge funds noticed bizarre, heavy distortions in the credit markets. Sensing blood in the water, rival firms began taking the other side of Ixil's bets en masse, systematically squeezing the chief investment office. When the media broke the story, J.P. Morgan executives famously dismissed it as a tempest in a teapot, fundamentally misunderstanding the lethal geometry of the trap. That tempest forced the bank to publicly admit a staggering $6.2 billion trading loss. The revelation destroyed J.P. Morgan's reputation as the undisputed master of risk management, resulting in over $1 billion in regulatory fines. Bruno Ixil avoided prosecution by turning state's evidence to expose the systemic failures, proving that even the most sophisticated safeguards are useless when mathematical models can be rewritten to hide toxic liabilities. On the morning of March 26, 2021, trading desks across Wall Street stared at a cascading wave of sell orders so massive it threatened to break the market's underlying plumbing. Blocks of shares worth $10, $20, and $30 billion were dumped at fire sale prices. Blue-chip media and tech conglomerates like Viacom, CBS, Discovery, and Tencent Music were in free fall. Inside the prime brokerage divisions of Goldman Sachs, Morgan Stanley, and Credit Suisse, risk managers realized they were trapped in a burning building. It wasn't a systemic crash. It was the implosion of a single, highly secretive family office in Midtown Manhattan. The architect of this financial crater was Sung Kook Hwang, known to Wall Street as Bill Hwang. A protege of legendary hedge fund manager Julian Robertson, Hwang had a dark track record. In 2012, his former fund, Tiger Asia Management, pleaded guilty to wire fraud, paying $44 million to settle SEC charges of insider trading and market manipulation. Banned from managing public money, Hwang simply pivoted. He converted his operation into Archegos Capital Management, a family office. This was the first critical glitch. By structuring Archegos to manage only personal wealth, Hwang bypassed regulatory tripwires. Family offices are exempt from filing Form 13F, the quarterly report requiring institutional managers to disclose equity holdings. Hwang was legally invisible to the watchdogs. To achieve $20 billion of market influence, he needed leverage. He found willing accomplices in the prime brokerage arms of global investment banks using a mechanism called the total return swap. A total return swap is a contract where a bank pays a client the return on an asset in exchange for a fee. The bank actually buys the underlying stock to hedge its exposure, holding the shares on its balance sheet. Hwang didn't own the millions of shares of Viacom CBS. He just owned their financial performance. This created a lethal blind spot. Because the banks were the registered owners, Archegos never triggered the SEC rule requiring disclosure for acquiring more than 5% of a company. Hwang quietly amassed positions so large he effectively controlled the float of several major corporations. More dangerously, he executed these swaps simultaneously across multiple banks. Credit Suisse didn't know what Morgan Stanley was doing. Nomura didn't know what Goldman Sachs was doing. Each thought they were servicing a wealthy client with a concentrated portfolio. None realized they were funding the exact same highly leveraged bets. Hwang took $1 billion in cash and spun it into $10 billion in market exposure. His synthetic buying pressure artificially drove up the price of the stocks he was betting on. By early 2021, the Archegos portfolio swelled to an estimated $100 billion in gross exposure. Prime brokers collected hundreds of millions in fees, entirely overriding their fiduciary duty to manage risk. The fragile architecture required constant upward momentum. On March 22, 2021, that momentum broke. Seeking to capitalize on its soaring stock price, Viacom CBS announced a $3 billion secondary stock offering. The market balked, realizing the stock was overvalued and the price slipped. As swap values plummeted, prime brokers issued margin calls demanding Archegos post cash collateral. Hwang didn't have it. What followed was a ruthless, multi-billion-dollar game of prisoner's dilemma. The prime brokers convened an emergency call to orchestrate an orderly unwinding. But there is no honor among banks. Goldman Sachs and Morgan Stanley recognized the math immediately. The first to sell takes a haircut, the last takes a decapitation. Goldman broke ranks, quietly liquidating massive blocks of stock. Morgan Stanley followed. By the time Credit Suisse and Nomura realized the coordinated unwind had failed, the market was flooded with supply. Prices cratered. The autopsy of Archegos revealed a staggering failure of institutional risk management. Nomura lost nearly $3 billion. Credit Suisse absorbed a catastrophic $5.5 billion hit. A fatal blow that severely weakened the institution and paved the way for its eventual forced acquisition by UBS. Bill Hwang was indicted on charges of racketeering conspiracy, securities fraud, and wire fraud, exposing how a single individual exploited the opaque mechanics of shadow banking to inflate stock prices and defraud the world's largest financial institutions. The collapse of Archegos was not an anomaly, it was a stress test that the system failed. It proved that despite the heavy regulations born from previous financial crises, the most dangerous threats still operate in the unregulated shadows, armed with synthetic leverage and shielded by a systemic willful ignorance. The glitch wasn't just in the reporting requirements. The glitch was the greed of the institutions that handed the matches to an arsonist. The fallout extended far beyond the immediate financial wreckage, triggering a frantic scramble among global regulators who realized they were flying completely blind. The SEC was forced to confront a massive regulatory void, exposing how family offices managing billions of dollars could operate entirely outside the purview of standard disclosures. In a matter of days, over $30 billion in wealth simply evaporated, wiped out in a relentless cascade of forced liquidations that left the broader market trembling and exposed the fragility of the entire prime brokerage model. In the wake of the collapse, the gleaming towers of Wall Street transformed into fortresses of paranoia. Inside the risk management divisions, executives desperately audited their own books, terrified that another highly leveraged phantom was hiding behind a smokescreen of total return swaps. The atmosphere was thick with suspicion and fear, a sudden chilling realization that the shadow banking sector possessed enough concentrated firepower to fracture the foundation of the global financial system without triggering a single early warning alarm. Bill Hwang's catastrophic downfall serves as the ultimate testament to the dangers of synthetic leverage and the illusion of infinite growth. His empire was built on a glitch in the regulatory matrix, fueled by the very banks that were supposed to serve as the first line of defense against systemic risk. As the wreckage of Archegos continues to smolder, it leaves behind a permanent, glaring warning about the nature of modern finance. The system is perfectly calibrated to enrich those who exploit its darkest corners right up until the exact second it incinerates them. The press conference room in Washington was dead silent. The Attorney General of the United States stepped to the podium to announce the largest kleptocracy seizure in history. The loss wasn't just in the billions, it was in the total erosion of trust in the global financial system. $4.5 billion, meant to build power plants and infrastructure for the people of Malaysia, had vanished. It was systematically siphoned out of a sovereign wealth fund and laundered through the pristine corridors of Wall Street's most elite institutions. This was not a simple embezzlement scheme. It was a hostile takeover of a nation's treasury, facilitated by the very banks trusted to guard it. At the center of this financial black hole was a man with no official title, no government office, and no fiduciary duty to the people he was robbing. Joe Low recognized a critical glitch in the architecture of international finance. Sovereign wealth funds are heavily regulated, subject to parliamentary oversight and strict auditing. But Lowe realized that if you establish a state-owned investment fund and immediately entangle it in complex joint ventures with opaque foreign entities, you effectively sever the chain of accountability. You transform a public trust into a shadow bank. To legitimize this shadow bank, known as 1MDB, Lowe needed the ultimate stamp of corporate approval. He found it in Goldman Sachs. The bank was hungry for emerging market revenue, and 1MDB was preparing to issue billions in sovereign bonds. These bonds were debt securities, essentially IOUs backed by the Malaysian government, sold to global investors to raise capital for domestic projects. Goldman Sachs agreed to underwrite these bond offerings, taking on the risk of selling them in exchange for a fee. But the fees Goldman extracted were astronomical, nearly 200 times the industry standard. The mechanics of the deception relied on a labyrinth of offshore shell companies designed to mimic legitimate institutions. When the first bond offering, codenamed Project Magnolia, closed, Goldman Sachs wired the raised capital to 1MDB accounts. Almost immediately, the money was diverted. Hundreds of millions of dollars were transferred to a British Virgin Islands entity called Abar Investments PJS Limited. This is the maneuver that allowed the fraud to flourish in plain sight. There was a legitimate state-owned Abu Dhabi fund named Abar Investments PJS. Lowe and his associates simply created a shell company with the exact same name, appending the word limited at the end. When compliance officers and auditors at global banks saw the wire transfers, they glanced at the name, assumed the funds were moving to the legitimate Abu Dhabi partner, and approved the transactions. It was a billion-dollar typo, weaponized to bypass international anti-money laundering protocols. The stolen capital flowed through Swiss bank accounts into the pockets of corrupt officials, Hollywood production companies, and luxury real estate developers. The facade of 1MDB was maintained through a classic Ponzi structure. As the interest payments on the Goldman Sachs bonds came due, 1MDB had no actual revenue from power plants or infrastructure projects to cover them. They had to issue new debt to pay off the old debt. Goldman Sachs underwrote two more massive bond offerings, codenamed Project Maximus and Project Catalyze, effectively dumping more gasoline on a fire they were being paid hundreds of millions of dollars to ignore. The survival of 1MDB did not rest solely on Joe Lowe's deception. It relied heavily on the willful blindness of the global banking system. Bankers at the highest levels circumvented their own internal compliance departments. When red flags were raised regarding the source of Lowe's wealth or the dubious nature of the shell companies, senior executives pushed the deals through anyway. The systemic failure was rooted in the incentive structure of Wall Street itself. Bonuses were tied to revenue generation, not risk mitigation. The fiduciary duty to protect the market was entirely subordinated to the pursuit of record-breaking commissions. The collapse was triggered not by a regulator, but by the sheer unsustainable weight of the debt. When 1MDB finally defaulted on a localized loan, the financial press began pulling at the threads. Investigative journalists obtained leaked emails and bank statements exposing the discrepancy between the billions raised and the total absence of physical assets in Malaysia. The moment the routing numbers connecting a fake Abar shell company to the personal bank accounts of political figures were published, the geopolitical fallout was instantaneous. In July 2016, the United States Department of Justice initiated the largest single action ever brought under the Kleptocracy Asset Recovery Initiative. Agents stepped to a podium in Washington to announce the seizure of assets not from a drug cartel, but from a sovereign wealth fund. They seized a Picasso, an original Van Gogh, a custom-built 300-foot super yacht, and the financing rights to a major Hollywood blockbuster. Over $4.5 billion had been siphoned directly from the citizens of Malaysia, laundered through the pristine corridors of Wall Street, and vanished into thin air. The initial heist had relied on a joint venture with a little-known Saudi oil company called Petro Saudi. Yes, MDB agreed to inject $1 billion into the partnership, but court documents reveal the anatomy of the diversion. Only $300 million actually reached the joint venture. The remaining $700 million was quietly routed to a Swiss bank account belonging to a shell company in the Seychelles, an entity entirely controlled by Joe Lowe. Lowe, a young Wharton graduate, held no official title or board seat, yet operated as the indispensable shadow broker. He understood the fatal glitch in the global banking system. Because the wire transfers originated from a state-owned fund, compliance officers rubber-stamped them. They saw sovereign wealth and didn't look for the man behind the curtain. To sustain the illusion, 1MDB enlisted Goldman Sachs to underwrite those massive bond offerings, including Project Magnolia alongside Maximus and Catalyze. The deals raised $6.5 billion for supposed infrastructure development. The systemic reveal lies in the fee structure. Goldman Sachs charged roughly $600 million in fees, nearly 10% of the total raised, compared to the fraction of 1% standard for sovereign bonds. The exorbitant premium was the price of looking the other way. Almost immediately after the bonds were priced, billions were diverted into offshore trusts and fake charitable foundations. The DOJ moved in, initiating global asset forfeitures. Goldman Sachs was forced to pay nearly $3 billion in global penalties, their pristine reputation permanently scarred. Senior bankers pleaded guilty to violating the Foreign Corrupt Practices Act, admitting they had bribed foreign officials to secure the deals. Yet, the architect of the scheme, Joe Low, vanished into the geopolitical ether, leaving behind a trail of seized assets and a nation burdened with fraudulent debt. The 1MDB scandal remains a cold-eyed testament to the predatory nature of modern finance. With enough leverage and the right corporate enablers, you don't need a gun to rob a country. You just need a bond offering. Meanwhile, inside the London branch of the Chief Investment Office, the atmosphere shifted from aggressive confidence to suffocating panic. The trading floor, once a theater of untouchable hubris, became a containment zone for a rapidly expanding financial disaster. Bruno Ixel had built a synthetic credit portfolio so massive that it could no longer maneuver in the shadows. Hedge funds had smelled the blood in the water, realizing that a single monolithic entity was on the other side of their trades. They began ruthlessly squeezing the positions, forcing the prices against the bank, and turning theoretical profits into very real bleeding wounds. The physical environment of the London office reflected its dangerous isolation from the rest of the bank's traditional risk architecture. Operating out of a sleek, high-security trading room thousands of miles away from corporate headquarters, the unit functioned as an autonomous empire. The traders were not executing client orders. They were managing a synthetic book that had swelled to hundreds of billions of dollars. At the core of the bank's defense was a mathematical fail-safe known as the value-at-risk model. This system was designed to calculate the maximum potential daily loss, acting as an automated tripwire against catastrophic exposure. Under normal circumstances, breaching a specific threshold would trigger immediate mandatory risk reduction. But the Chief Investment Office found a glitch they could exploit. When the original model began flashing red, signaling an unacceptable level of risk, executives did not reduce their positions. Instead, they changed the math. They implemented a new, highly optimized model that instantly slashed the reported risk profile by half. By altering the underlying volatility calculations, they effectively turned off the fire alarm while the building was already burning, granting themselves the artificial runway to double down on losing bets. With the new model masking the structural danger, the daily procedure devolved into frantic accounting fiction. Traders began aggressively mismarking their positions, logging the value of complex derivatives at prices that defied the open market to delay the recognition of hundreds of millions in daily losses. The mid-office staff tasked with verifying these valuations were pressured into accepting the inflated numbers. Internal communications reveal a procedural breakdown of staggering proportions. When junior risk managers noticed the widening chasm between market reality and internal spreadsheets, their warnings were systematically suppressed. Emails detailing the aggressive pricing were routed into an administrative void by senior managers desperate to maintain the illusion of a perfectly hedged portfolio. The illusion finally shattered when market forces crushed the artificial valuations. The bank was forced to publicly disclose a staggering $6.2 billion trading loss, erasing billions in shareholder value overnight. The London whale was no longer just a market rumor. It was the most expensive cautionary tale in modern banking history. The fallout triggered a merciless regulatory reckoning. Investigations by the SEC and international authorities dismantled the defense that these trades were merely complex hedges. The evidence proved the unit was placing massive, directional bets with federally insured deposits. Senior executives were ousted, massive fines were levied, and internal risk models were subjected to forensic audits. Ultimately, the scandal became the definitive catalyst for enforcing the Volcker rule. Regulators used the catastrophic loss as undeniable proof that banks could not self-regulate the boundary between prudent hedging and reckless proprietary trading, permanently dismantling internal hedge funds and fundamentally restructuring global financial oversight. A similar illusion of invincibility was being carefully constructed in Aschheim, Germany. Wirecard was the pride of European tech, a digital payments behemoth that had clawed its way to the top of the DAX index, replacing Commerzbank among the corporate elite. The architects of this mirage were CEO Markus Braun and his chief operating officer John Marsalek. Braun, a former consultant with an obsession for artificial intelligence and scale, cultivated a carefully curated aura of inevitability. He wore black turtlenecks, spoke in Silicon Valley platitudes about the future of digital transactions, and positioned Wirecard as the indispensable bridge between traditional banking and the digital economy. Marsalek, meanwhile, operated more like a shadow intelligence asset than a corporate executive, managing the company's darkest operational corners. Their business model relied on a calculated exploitation of international banking borders. They utilized a complex web of offshore accounts and intermediary processors known as third-party acquiring. By routing transactions through outsourced partners in Dubai, Singapore, and the Philippines, Wirecard created a financial black box. This opaque architecture allowed them to fabricate revenue out of thin air, inflating their valuation to $30 billion and setting the stage for a systemic deception engineered over a decade. Inside the Munich headquarters of Europe's most celebrated financial technology company, the atmosphere has turned to ash. The auditors from EY have just delivered a fatal blow. They will not sign the annual report. Down in the Philippines, two banks have confirmed that escrow accounts supposedly holding 1.9 billion euros are entirely fictitious. The money is not missing. It never existed. Within hours, a titan of the DAX 30 index will collapse into insolvency, incinerating over 20 billion euros in market value. The loss wasn't just in the billions, it was in the total erosion of trust in the global financial regulatory system. To understand how a digital payments processor engineered the most brazen accounting fraud in modern European history, you have to look at the architecture of the deception. Wirecard did not start in the polished boardrooms of Frankfurt. It clawed its way up through the gray markets of the early internet, processing credit card transactions for pornography and online gambling. Traditional banks refused to touch it. Under the control of its enigmatic CEO, Marcus Braun, the company realized that processing the world's undesirable transactions provided the perfect cover for something far more lucrative. On June 18, 2020, the foundation of the European financial establishment cracked in real time. The auditors at EY refused to sign off on the annual accounts of Germany's most celebrated technology darling. $2.1 billion supposedly sitting in escrow accounts in the Philippines simply did not exist. The loss wasn't just measured in the billions of shareholder value wiped out in a matter of hours. It was the total erosion of trust in a regulatory system that had spent a decade looking the other way. This was the sudden, catastrophic unraveling of Wirecard, a $28 billion mirage built on forged documents, shadow banking, and an audacity that paralyzed the watchdogs. To understand how a payment processor engineered the greatest corporate fraud in modern European history, you have to look at the genesis of the machine. Under the control of CEO Marcus Braun and his enigmatic deputy, Jan Marsalek, Wirecard didn't start in the prestigious financial hubs of Frankfurt or London. It clawed its way up through the gray markets of the early internet, processing credit card transactions for online gambling and pornography. These were high-risk, high-margin sectors that traditional banks refused to touch. For months, executives promised that the missing 1.9 billion euros were sitting safely in escrow accounts in the Philippines. They refused to sign off on the annual report. The loss wasn't just in the billions, it was in the total erosion of trust, exposing a blind spot so massive it brought the entire German financial regulatory apparatus to its knees. Within days, a 24 billion euro corporate titan will be reduced to penny stock, its CEO behind bars, and its chief operating officer an international fugitive. This wasn't a sudden failure of market conditions. It was a meticulously engineered illusion, built over 2 decades on the back of the internet's most lucrative and legally ambiguous sectors. Wirecard began in the late 90s, processing credit card transactions for online gambling and pornography, high-risk industries that traditional banks refused to touch. Under the leadership of Marcus Braun, a former consultant who cultivated the aura of a tech visionary, and Jan Marsalek, a shadow operator with a taste for espionage, Wirecard pivoted. They aggressively acquired smaller payment processors across the globe, projecting the image of an unstoppable fintech juggernaut. They didn't just process payments, they issued cards, managed risk, and eventually obtained a full banking license. The boardroom in Aschheim, Germany, is suffocating under the weight of a single missing document. Ernst & Young, the auditor that had rubber-stamped the corporate books for a decade, finally refuses to sign. The discrepancy they found is not a rounding error or a minor accounting oversight. Cash that is supposedly sitting in 2 Philippine banks, forming the bedrock of Europe's most celebrated fintech empire. But the bank certificates are forged before the international arrest warrants and the missing billions. Wirecard was the ultimate underdog story of the dot-com crash. At the helm is Marcus Braun, a former KPMG consultant who takes over a struggling payment processor in 2002. Braun is selling a vision of a frictionless, cashless future, but the early reality is far less glamorous. Wirecard survives by processing transactions the traditional banking sector refuses to touch. primarily online gambling and adult entertainment. It is a high-risk, high-margin ecosystem. This shadow economy requires specialized financial plumbing. Braun builds a machine designed to obscure the origin of funds, a feature that makes Wirecard indispensable to offshore casinos and eventually a massive liability to global regulators. Inside the Munich headquarters of Europe's most celebrated financial technology empire, the walls are rapidly closing in. The company's longtime auditor, EY, has just delivered a fatal blow. They cannot locate 1.9 billion euros in cash. It is a quarter of the company's entire balance sheet wiped from existence. Within days, the CEO will be behind bars, the COO will vanish on a private jet bound for Belarus, and 24 billion euros in market capitalization will evaporate into thin air. The loss wasn't just in the billions, it was in the total erosion of trust, exposing a catastrophic failure at the highest levels of global financial oversight. This was not a sudden market crash. This was Wirecard, a meticulously engineered corporate mirage that weaponized the complexity of digital payments to execute one of the most audacious accounting frauds in modern history. June 25, 2020. The Munich headquarters of Europe's most celebrated financial technology company is paralyzed. Board members are scrambling, regulators are in free fall, and somewhere over the airspace of Eastern Europe, the chief operating officer is vanishing into thin air on a chartered jet. The catalyst for this panic is a gaping, unexplainable hole in the company's balance sheet. 9 billion euros, supposedly sitting in secure escrow accounts in the Philippines, simply does not exist. This is the moment Wirecard, a 24 billion euro titan of industry, shatters. To understand how a massive corporate entity fabricated billions in revenue out of thin air, you have to look at the genesis of the machine. Wirecard did not start in the polished boardrooms of traditional banking. It began in the late 90s, processing payments for the dark corners of the internet, handling high-risk transactions for pornography and online gambling that legacy banks refused to touch. Markus Braun, an Austrian tech consultant with a penchant for black turtlenecks and absolute control, took over the struggling company and saw a structural vulnerability he could exploit. He pivoted Wirecard from a fringe payment processor into a global financial intermediary. The pitch was seamless. Wirecard would handle the complex back end of digital transactions for merchants worldwide, acting as the invisible bridge between consumers and banks. As e-commerce exploded, so did Wirecard's transaction volume. They acquired smaller payment companies across Asia and the Middle East, expanding their footprint at an aggressive, almost unnatural pace. The Munich headquarters of Europe's most celebrated fintech giant is suffocating in silence. The auditors from Ernst & Young have just delivered the fatal blow, refusing to sign off on the annual accounts. 1.9 billion euros, supposedly sitting in escrow accounts in the Philippines, simply does not exist. The loss wasn't just in the billions. It was in the total erosion of trust in the global financial establishment. A DAX 30 company, valued higher than Deutsche Bank, is suddenly exposed as a hollow shell, triggering the most catastrophic corporate collapse in modern European history. To understand how a phantom enterprise infiltrated the highest echelons of global finance, you have to look at the glitch in the system. You have to understand the mechanism that allowed Wirecard to fabricate its own reality in plain sight.